Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So in today's webinar, we will be moving forward with our new topics. But before jumping to our new topics, we will see what we covered previously in our sessions. So we have covered our WACC, then importance of doing WACC and formula for the same, and risk averse investors and marginal return. We have discussed beta and regression approach, bottoms up beta, mean reversion and beta drifting we have studied in our previous session. So now in our coming session, first of all we will be understanding return on market. So in return on market refers to the average return earned by investors from the overall stock market. It also shows how the market as a whole performed over a year. So it means like return on market is how much profit or return investors made on average from the entire market index, such as Nifty 50 in India, Sensex in India, S&P 500 in the US. So this includes the increase in the index value, which is capital gain, and dividends paid by companies in the index. So it represents overall market performance. So why is it important? So it helps comparing the performance of our stock or mutual fund with the overall market. Also it is used in CAPM model, which is capital asset pricing model, to find expected return on a stock, and it also helps identifying if we are outperforming or underperforming in the market. So for the same formula we use market return is equals to ending index value minus beginning index value divided by beginning index value into 100 plus dividend yield. So for example, we can take one example for the same. So Nifty 50 last year's return on market was 18,000 and Nifty 50 this year was 20,000. So average dividend yield we have calculated as 1.50. Now if we want to calculate our return, so it will be the formula as I said, it will be 20,000 minus 18,000 into 100 and divided by 18,000. Then we will be getting 11.111 percentage. And if we calculate our market return, so I have calculated as it this return plus average dividend yield, so it will be giving us 12.611. So the overall market gave us a 12.61 percentage return this year, right? Then comes our average return. So average return tells us the typical return we earn per year over multiple years of investing, and also it shows the long-term profitability of an investment. There are two types of average return, like arithmetic average return where simple average is calculated, and geometric average return where it is compounded annual growth rate, which is CAGR. So for simplicity we use arithmetic here. So for calculating, average return is equals to sum of returns over n years divided by n, which is number of years. So if we want to calculate, in year 1 10% was the return, in year 2 5% it is, and in year 3 12%, and year 4 it is 8%. So if we calculate our average return, so we have done the sum of these digits and I have divided by 4 because the years are 4. So we are getting 8.75% for the same. Next is our why it matters. It helps evaluating past performance and useful in portfolio return analysis, and it is used for comparing different investments also. Then comes our dividend yield, where dividend yield shows us how much cash income, which is dividend, we earn from every 100 rupees invested in a stock. So it is a percentage that compares dividend per share to market price of the share. So for the same calculation we will be using formula dividend yield is equals to dividend per share divided by market price into 100. For example, if our company pays 8 rupees dividend per share and our share market price is 200 rupees, so for calculation we have done over here 8 divided by 200 into 100, which will be giving us 4% dividend yield. So we earn 4 rupees annually for every 100 rupees invested. So why is it matters? So it is income focused investors use it to pick stocks, and high yield is equals to good cash flow, but must also check company's health, and it helps comparing with FD rates or bond yields. Next comes our intrinsic growth rate, which is internal growth rate of the company. So it shows the maximum growth rate a company can achieve using only its own earnings, which is retained profit, without borrowing or issuing more shares. So it tells us how fast can the company grow from inside without any external help. So for the same, we will be calculating it through a formula, which is ROA into retention ratio, where ROA is return on assets, where it is calculated as net income divided by total assets, and retention ratio is equals to 1 minus dividend payout ratio. So for example, net income, let's suppose our net income is 10 lakh and our total assets is 1 crore. So if we want to check ROA, so we will be doing net income divided by our total assets, then we will be getting 10% of ROA, where company pays 40% of profits as dividend. So our retention ratio will be 1 minus dividend payout ratio is 40%, so we will be converting it in 0.4, and then we will be getting 0.6. So intrinsic growth rate will be calculated as 10% of our ROA into 0.6, which will be giving us 6%. So the company can grow at 6% per year without external funds. So why it matters? So it helps management plan growth using retained earnings. It shows self-sustainability of a business, and useful in valuation models like Gordon growth model, which we have discussed in our previous session about Gordon growth method and exit multiple method, and we have also discussed the examples related to it. Then comes our common size statement, where a common size statement is a financial statement in which all line items are shown as a percentage of a common base. Its purpose is to make it easy to compare different companies, the same company over the time, like that. So types of common size statement which we come through is common size income statement, where all items shown as percentage of sales, and common size balance sheet, where all items shown as percentage of total assets. So for example, we have common size statement over here. So we have to calculate our sales. So amount is 1 lakh. So if we want to check percentage of sale, it will be 100%. Then if I want cost of goods sold, it is 60,000, then it will be 60%. Then I have to calculate gross profit, so it is 40,000, then it is 40% of sales. And if we calculate our operating expenses, which is 20,000, it is 20% of sales. And net profit, if we want to calculate, it is 20,000 in amount, and if we are converting it in percentage of sales, so it is 20%. So why it matters? Because it helps identifying cost structure, makes it easy to benchmark competitors, and use in vertical analysis and trend analysis, and also supports decision making in finance. Now let's do some practice in Excel for the same. So before moving forward, we will be doing return on market, which we have discussed in our previous session about how to do that. So this is my Srina.in, and I have also opened investing.com. So if required, we will be using both, or only one we can also use. So now I am taking my Eicher Motors, which I have taken for my financial statements. Now if I move down, I will be getting my peer comparison over here. So we don't have to go here, and we just have to move down. It is giving us that our Eicher Motors is having this, right? So I have given my columns as debt to equity and market capitalization because I require that. And when I save the columns, it will be showing me these market shares. And if I select this, or let's suppose I am taking these 7 over here, and I can just copy it and I can paste over here like Control Alt and V, and then text and OK. Now it will be pasted to it, right? So this is what we will be getting for our return on market as per the screener.in, right? So if we want to calculate our common size statement, which we have discussed in our session today, so common size statements are of two types, which is common size one second, it is okay. So our income statement was freezed, so it was not visible for us. So again, right, this should be unfreezed and this should be freeze because we have to do calculation, so we want to see, right? So I have created over here my raw financial statements. What I have done over here, the data sheet I am having with me in my financial statements which I have discussed, I have already copied it, or we can say linked it with my data sheet which I have for Eicher Motors. So which I have told you all earlier that my sales is 100% because I have given $sign, which is absolute anchoring to my sales, which is directly linked with my financial statements which I have prepared and the data I have downloaded from screener.in. So they are all linked it with the same thing. Like that only I have linked my whole data, like my raw material cost, change in inventory, and power and fuel. Every single thing I have copy pasted as it is from my income statement which I have prepared while doing financial statement. Like that only we will be doing our calculation. So in our PPT also we have discussed that our common size statement is a financial statement. Okay, so first is our income statement, which is calculated from percentage of sales, and our balance sheet with our total assets. So like the same thing I have done over here also, that I have taken my total assets as 100% only, and my net block is linked it with data sheet only. So I have taken these heads also, and now what I have done, my net block amount which is divided by my total assets, and now I will be getting this much. Okay, so if we are calculating other assets, so what I will be doing, I will be deducting my receivables and inventory because they are included in my other assets, and then once I will be calculating my other assets, I will be dividing it by total assets, and receivables and inventory will be also divided by my total assets because they are now individual entity, and it can be divided by my total assets, right? Like total liabilities also, it is 100% first of all, but if we are calculating on equity share capital, so the amount of equity share capital will be divided by total liabilities. Same goes with reserves, borrowings and other liabilities. Like this we can prepare our common size balance sheet of Eicher Motors. And if I want to calculate my income statement of Eicher Motors, what I will be doing, I will be doing sales which is 100% till the March 24, and raw material cost which I have taken from my data sheet only, where I am having income statement of the data which is available in my screener.in. So I have divided it by my sales because my income statement will be calculated on sales only, and my balance sheet will be calculated on percentage of total assets, right? So this is how we can prepare our common size statement. Now if I want to calculate my intrinsic growth, what I have done, I have linked it with my again data sheet where I have taken different heads so that I can classify it individually. Like current assets, in current assets I am having inventory, trade receivables, loans and advances, other asset items, and then I have calculated my total current assets. Then if I want current liabilities, so I have calculated it individually, like trade payables is there, advance from customers and other liability items. Through this I have calculated. Now if I want to calculate my net working capital, so I have done subtraction of my total current assets and total current liabilities, so it will be giving me 1159 rupees, or net working capital will be 1159 in negative. Now if I want to calculate my non-current assets, so in non-current assets my land, building, plant and machinery, equipments, furniture and fittings, vehicles, intangible assets, other fixed assets will be coming. So if I calculate all those things, then I will be getting my gross block, which is calculation of my this data. And again, once my calculation is done, I have copy pasted it till the end. And now if I want my accumulated depreciation, so I have done this accumulated depreciation, and I have to calculate my net non-current asset, so I have calculated in through my these two only, and I have entered the same. So my net non-current assets will be 2377. Now invested capital is 1218, so it is according to my net working capital and net non-current assets, it will be coming is 1218. Like that only we have dragged it till the March 24. And one thing, I have taken last 5 years data only so that I can calculate it more easily and no problem will be there. Now if I want to calculate my EBIT, where I have taken it from my financial statements data sheet only, and now if I want to calculate my ROIC, so I have divided my EBIT with my invested capital, then I will be getting my ROIC also. So I have to do one thing, right? So I have divided my EBIT, which is 1864.21, and invested capital, which is 1218. Like that we can do our intrinsic growth rate calculation. Now if I want to calculate my RM, so for that what I will be doing, I will be going to my this page screener.in, where I will be typing prime investor, and once I come here in prime investor, what I will be doing, I will be clicking on more option, it will be showing me tools. Now what I will be doing, I want Nifty 50 returns chart, right? So it will be opening my last year 20 years Nifty 50 returns. Now what I have to do, I have to download it, right? So here we are not finding any data. So in the end of this table we will be getting primeinvestors.in get the data, and when once we download it, it will be showing us this sheet. And also after this sheet will be opened like this, we don't want this data, we just want annual data. So we will be copying it and then pasting it in our annual data, and year will be 2000 from 2000 to 2024, because 2025 data is not available because we are taking annual returns. So 2025 data is not available. If we check for our 2026 year, then for 2025 it will be available, but now in 2025 we will be getting till 24 only. So if we want to calculate our average return, so we will be calculating it through average function and selecting the annual data which we have taken from our primeinvestor.com, and once we click on enter, it will be showing us 15.33%. so with this average return, what we will be getting that Nifty has given us the return of 15.33% in past 20 years. So this return is on actual price, right? Then if I want to calculate my dividend yield, so I will be again going to my primeinvestor.com, and I will be coming down here. I will be getting my dividend yield, which is 1.29, right? So I have hard coded it with my 1 sign, which is superscript. Now if I want to calculate my total market return, so what I have done a sum of these two, and I will be getting my 15.33% as my total market return. So I will be doing this, right, and this will be black, right? So this is how we can calculate our return on market. So please keep in mind that when we are calculating for common size income statement, we will be calculating it on percentage of sales, and if we are doing it for common size balance sheet, then it will be always on percentage of total assets. So why it matters? It helps identifying cost structure, makes it easy to benchmark competitors and use in vertical analysis and trend analysis, and supports decision making in finance. So we have done our practice also in Excel. So as we wrap up today's session, let's quickly revisit the key takeaways. Where return on market, it helps us understanding how the overall market performs, giving us a benchmark to compare our investments, right? Second is our average return, where it tells us the typical profitability over the time, helping us evaluate performance consistency. And dividend yield shows us the income potential of our stock, guiding investors who seek steady cash flow. Intrinsic growth rate, where it reveals how fast a company can grow using its own profit without external funding. And the common size statement, where it simplifies financial comparison across the time and companies by expressing everything as a percentage, making it a powerful analysis tool. So each of these concepts plays a vital role in a financial analysis, investment decision making, and business performance tracking. So thank you all for your active participation and engagement. Whether you are a student or finance professional or just someone curious about investments, understanding these core financial metrics builds a solid foundation for better financial judgment. So if you found the session valuable, please feel to connect, share your feedback, and stay tuned for upcoming webinars where we will be dive even better and deeper into the world of finance. Until next time, keep learning, keep growing, and remember, numbers may look complicated, but once we understand the story behind them, finance becomes fascinating. Thank you and take care.